Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, The Truth Behind How Heated Rivalry Got Made. Sean Cohan received a television script that began with a surprising disclaimer. This will read almost like pornography, but please know that it's not going to be shot that way. Most executives would have hesitated. In Canada, where Cohan now works, television studios are known for caution. Spiking production costs, fear of flops, risk of audience backlash. They typically co-finance shows to keep costs in check and spread risk, but they're forced to share ownership when they do. Cohan is an American, former executive at Nielsen and A+E Networks. He relocated from New York to Toronto in 2003 to run Bell Media, a division of telecom giant Bell Canada. He arrived from a system that rewards risk. He arrived from a system that understands that something timid never becomes cultural. So when Bell Media's Hunters for Bold Romance, their version of Netflix's Bridgerton, brought him this racy script about two pro hockey players grappling with secret lust and fierce athletic competition, from one of their most trusted showrunners, Cohan made a decision that is rare in Canadian television. He said yes. Not just yes. He said, if it's good, and you believe in it, and it's objectively defendable, then let's roll. And he decided to pay for it alone. That decision is worth studying because it reveals something fundamental about capital allocation under uncertainty. It reveals what happens when an outsider arrives in a risk-averse system and is willing to break the rules. Here's the context. In Canada, television studios typically co-finance shows. That's the norm. It spreads costs, it spreads risk, but it forces them to share ownership and to negotiate with partners who have different visions, partners who want different things from the final product. Bell Media had been hunting for prestige drama in the romance space. They wanted something that could compete with Netflix's Bridgerton. They wanted something that could dominate cultural conversation. They wanted something that was theirs. The script came from Jacob Tierney, who had previously produced hits for them, Letterkenny and Shoresy, comedies with strong U.S. followings. Tierney had credibility. Tierney had a track record. Tierney could be trusted. But the script was racy. The script was sexually explicit. The script was about gay sex. In a country known for its tempered approach to homegrown entertainment, that's not the default move. So Cohan had to make a decision. Co-finance it and negotiate with partners about toning it down, dialing back the sex, adding characters that aren't in the source material. Or finance it alone and give Tierney the freedom to execute his vision. He chose the latter. He chose to finance Heated Rivalry alone. He chose to keep the creative vision intact. He chose to say to his team, the reason some potential partners wanted to deviate from the source material is because they're afraid. And we're not going to be afraid. That's a capital allocation decision. It's a bet that Tierney's vision is worth the money. It's a bet that the source material, a series of romance novels by a Canadian author named Rachel Reed, has a rabid fan base that will show up if the show is true to the books. It's a bet that you don't compete with Bridgerton by making something safer. You compete by making something bolder. Let me paint you a picture of what actually happened. On Thanksgiving, with almost no advance promotion, Heated Rivalry hit streaming services. On Crave in Canada, on HBO Max in the US, and it immediately hooked a feverish audience. During the holiday break, people on both sides of the border were asking each other, have you watched the gay hockey romance? The chatter turned it into the most successful original series of the streaming era by far for Bell Media. Not just successful, the most successful. On average, episodes in the 6-part season were re-watched by a third of the show's viewers on Crave. More than 15% of viewers watched an episode 5 times or more. That's not casual consumption. That's obsession. That's the kind of engagement that only happens when you've made something that resonates deeply. On HBO Max, episodes are averaging 8 million US viewers, and the audience has grown. Last week, Heated Rivalry hit a series high for weekly viewership. HBO Max says the show's audience is roughly 2/3 female. Think about that. A show about gay hockey players, primarily watched by women. That tells you something about the quality of the writing and the depth of the drama. The sex scenes matter, but the drama underneath matters more. Now let's think about the capital allocation decision in detail. Cohan flew solo. He financed the entire show without co-financing partners. That meant Bell Media bore the entire production cost. That meant the entire risk was on Bell Media's balance sheet. That meant if the show flopped, if it was unwatchable, if the audience rejected it, Bell Media lost everything. What was expected? A risky show that might find an audience. A show that might damage Bell Media's reputation if it was seen as gratuitous. A show that might fail to reach mainstream acceptance in a conservative media market like Canada. What actually happened? A cultural phenomenon. A show that dominated conversation. A show that became the highest-grossing original series in Bell Media's history. A show that proved Cohan's instinct was correct. The opportunity cost was enormous. If the show had failed, if it had been pulled after one episode, if the audience had rejected it, Bell Media would have spent millions on a flop and would have diminished its brand. Cohan would have been wrong. And the lesson in Canadian media would have been, don't take risks. Don't finance alone. Don't back bold content. Instead, Cohan was right. And the lesson is the opposite. Here's what I find remarkable about the capital allocation chain. Cohan arrived from the US, where risk is celebrated. He arrived in Canada, where risk is feared. He saw content hunters who wanted something bold, but were constrained by the system. He saw a showrunner with a track record. He saw source material with a rabid fan base. He saw a cultural moment where there was hunger for queer stories told without apology. And he said, I'm going to bet on all of that. The pricing also matters. The deal with HBO Max to license Heated Rivalry in the US was finalized about 2 weeks before it premiered. That's timing. That's not a pre-planned content strategy. That's Cohan and his team moving fast, making the decision to accelerate the release date from February to Thanksgiving because they believed in the show and they wanted to hit the right cultural moment. They initially planned to premiere the show after the Winter Olympics. That was the default strategy. Olympic timing. People would have hockey on the brain. But as the edits came in from Tierney, as executives' confidence grew, they realized, no, we need to move faster. We need to hit the Thanksgiving through New Year window when people actively hunt for new shows to fill their vacation hours. That's dynamic capital allocation. That's not a plan executed robotically. That's a team that believes in what they have and is willing to adjust the strategy to maximize the moment. Let me extract the lessons because there's something important here about how media companies create value. First lesson, trust the showrunner. Cohan didn't micromanage Tierney. He didn't send notes about the sex scenes. He didn't suggest adding characters. He said, I trust you. Do your thing. Make it true to the source material. Make it bold. Make it yours. That's a capital allocation decision that trusts the creative operator more than the financial operator. Second lesson, don't co-finance to split risk if it means compromising vision. The Canadian model is to spread risk by bringing in multiple partners, but each partner brings different incentives. Each partner wants different things. Cohan said, no, I'm going to bet on this completely. I'm going to own the risk and own the reward, and that ownership is worth the financial exposure because it preserves the creative integrity. Third lesson, source material matters. Heated Rivalry isn't an original idea. It's based on romance novels that already had a rabid fan base. Cohan understood that a show based on source material with an existing audience is less risky than an original idea. Even if the source material is controversial, the fans will show up. The fans will watch. The fans will evangelize. Here's what I think happened at Bell Media. Cohan arrived and understood something his predecessor might not have. In an age of infinite content, the only thing that matters is distinctiveness. You can't outbudget Netflix, you can't outmarket Disney, but you can make something that's so bold, so true to its source material, so unafraid to be sexual and queer and dramatic that it becomes unmissable. That's a capital allocation insight that only an outsider could bring. Someone steeped in Canadian media would have said, co-finance it, spread the risk, tone down the sex, make it palatable to mainstream audiences. Cohan said, no, make it unmissable. And he was right. Here's what I'll leave you with. Bell Media had a choice. They could have made a safe show, a show that didn't offend anyone, a show that was watchable but forgettable. Or they could have made a show that was so bold, so true to the source material, so unapologetically queer and sexy that it would become the most successful series in the company's history. Cohen chose the latter. He chose to break the Canadian media convention of co-financing. He chose to bet the entire budget on Tierney's vision. He chose to move fast and hit the right cultural moment. And Heated Rivalry became not just a success, but a phenomenon. Not just a hit, but the most successful original series in Bell Media's streaming era. Not just watchable, but unmissable. That's what happens when an operator with conviction arrives in a risk-averse system and is willing to break the rules in service of a bigger vision. Moving to next title, a star strategist betting on robots and flying cars. Adam Jonas compares his approach as a top researcher at Morgan Stanley to a lobster fisherman. If he lays enough traps at the bottom of the sea, in corners that are otherwise ignored, he's likely to come back with something no one else has noticed. That's not poetry. That's capital allocation. That's what happens when an intelligent analyst understands that the market prices consensus heavily and ignores everything else. The things the market thinks are too low probability or too long-term are exactly the things that compound into massive returns if you're right. Jonas is 51 years old. He's Morgan Stanley's chief robot strategist, a role the bank created for him in the fall. His actual title is Global Embodied AI Strategist. This is a new position for Morgan Stanley. The bank created it because the ultra-wealthy are increasingly moving capital into private markets. They're buying and selling shares of private companies long before those companies list on public stock exchanges. And they want sophisticated analysis on where that capital should flow. Jonas is positioned to capture that opportunity. But he didn't start there. He started as an auto analyst. Here's the operator dynamic. Jonas started covering autos as an investment banker in 1996, right out of college. He became Morgan Stanley's lead European auto analyst in London at age 28. He had credibility. He had a track record. He had built a brand in a mature, well-understood sector. Then, in 2008, something changed. He met Elon Musk at the SpaceX rocket factory in Hawthorne, California. I was kind of rewired, Jonas says. He understood something at that moment. He understood how Musk could get really talented people with lots of capital to do crazy stuff that's impossible until it isn't. That one meeting rewired his entire analytical framework. That one meeting showed him where capital would flow in the future. In 2010, Jonas moved to New York to take over global auto coverage for Morgan Stanley. But he wasn't covering autos the traditional way anymore. He was covering autos through the lens of disruption. He became a vocal Tesla bull when Tesla was trading in the single digits. He set a $70 price target for Tesla, nearly 3 times where the company was trading. He called Tesla America's fourth automaker, which was an affront to the Big Three in Detroit. By 2025, Tesla has a market cap of $1.4 trillion. The company is larger than the following 22 automakers' market caps combined. Jonas was right. He saw the future when almost everyone else missed it. And he built a reputation for asking provocative questions. In 2015, he asked if Tesla would compete with Uber. Musk paused for so long before responding that TechCrunch called it an awkward silence. In 2017, he asked if Tesla would use SpaceX tech in its vehicles. Musk groaned. The Financial Times called it the time Adam got even Elon to roll his eyes at a question. A year later, Musk was promoting a new design for roadsters with what he called small rocket thrusters. That's the power of being right about the future. Your questions, your ideas, eventually become the company's strategy. Now here's where the capital allocation insight gets deep. Jonas had massive credibility as an auto analyst. He was respected. He was listened to. He could have spent the next 15 years being the world's greatest Tesla analyst. He could have compounded his knowledge and his brand in that one sector. Instead, he pivoted. He saw that autos were just the first domino, that the real opportunity was broader, that the real future was robots, autonomous vehicles, humanoids, and industrial automation. He saw a Cambrian explosion of bots, a time in the not-so-distant future when fully autonomous vehicles, drones, humanoids, and industrial robots grow large enough in population to rival the human race. His theory is deceptively simple. Anything that can be automated will be automated, even humans. American companies either build that future themselves or cede their future to the countries and companies that do. Morgan Stanley, recognizing Jonas's brand and his insight, created an entirely new research role for him, Global Embodied AI Strategist. Chief Robot Strategist. This is a bet that Jonas is right about where the future capital flows. Now let's look at the numbers Jonas is forecasting. In a report last month, he forecast $1.4 billion in annual robot sales by 2050, bringing in $25 trillion in global revenue. That's not a typo. 25 trillion with a T. Robotics hardware alone is currently a $91 billion industry. Jonas forecasts it will grow to around $540 billion in 2030. Then, $2.7 trillion by 2035, before accelerating to $25 trillion in 2050. The sale of software, services, maintenance, and various supply chains could multiply those figures even further. Now, here's the capital allocation question. How do you position yourself to capture that opportunity? Jonas isn't saying buy robots. He's not making a simple product recommendation. He's mapping the entire ecosystem. He's published a series called The Robot Almanac, a guide to future business opportunities and the many companies already working on such technology across industries, from AI and software to supply chains and data centers. It's not just Tesla and SpaceX. It's the data center operators who provide the computing infrastructure. It's the AI companies that train the models. It's the supply chain companies that move the hardware. It's the logistics networks that deploy the robots. It's the insurance companies that underwrite the risks. That's how you capture a secular wave. You don't just pick the obvious winners. You map the entire ecosystem and show your clients where capital should flow at every level. Here's what makes Jonas an exceptional allocator. He's not hiding from the risks. He's naming them. He acknowledges that in the long run, robots could displace human workers. He says it will be up to parents, governments, and society to answer questions like, what does it mean to be human? And to figure out how to ensure against unintended consequences. He's influenced by science fiction. He likes H.G. Wells. He likes the 1920s play R.U.R. by Czech playwright Karel Čapek, which is credited with popularizing the word robot. The play tells a story of sentient robots who rebel against human creators. Read this short play and you'll think twice before kicking a robot again. Jonas wrote in a November investor note. That's remarkable. He's not selling an optimistic vision of the future. He's selling a realistic one that acknowledges the risks, the disruption, the potential for unintended consequences. And he's saying, this is coming regardless. Your job as an investor is to understand it and position yourself accordingly. Let me extract the lessons because there's something important here about how research creates capital allocation advantage. First lesson, rewiring happens when you meet genius. Jonas spent years as a competent auto analyst, but when he met Musk at SpaceX, his entire framework changed. He understood something at that moment about how capital flows to the impossible until it isn't. That one meeting redirected the entire course of his career. The lesson is, the most important work you can do is to position yourself where genius is operating, because genius expands your conception of what's possible. Second lesson, conviction about the future allows you to ask better questions today. Jonas became famous for provocative questions. Will Tesla compete with Uber? Will Tesla use SpaceX tech? These weren't random questions. They were questions that anticipated the company's future evolution. They were questions that said, I understand where this is going, and I'm testing whether management understands it too. That's a capital allocation skill. Third lesson, build ecosystems, not point bets. Jonas isn't saying buy one stock or one robot. He's mapping the entire value chain. He's saying, this future is going to require data centers, AI companies, supply chains, logistics networks, insurance companies. Understanding the full ecosystem is what separates generalists from strategists. Here's what I think happened to Jonas's career. He was successful as a Tesla analyst. He had credibility. He could have stayed there, but he understood something fundamental. The most valuable research in the future won't be about one company or one sector. It will be about understanding where capital is flowing at the macro level. It will be about anticipating waves before they become obvious. So he pivoted. He created a new category. He positioned Morgan Stanley as the place for ultra-wealthy clients to understand the robotics wave. That's not just research. That's capital allocation strategy embedded in institutional positioning. Now here's the execution risk. Jonas is betting that the robotics wave is real. He's betting that capital will flow into the ecosystem he's mapping. He's betting that Morgan Stanley clients will listen to his analysis and allocate accordingly. If he's wrong, if the wave doesn't materialize, if the technology progresses much slower than he forecasts, then his analysis becomes a historical curiosity instead of predictive intelligence. But if he's right, if the Cambrian explosion of bots happens as he forecasts, if companies allocate capital into the ecosystem he's identified, then Jonas will have been ahead of the wave by a decade or more. His analysis will have captured value at every level. That's the asymmetry. The downside is reputational. The upside is that you shaped how a generation of capital allocators thought about the future. Here's what I'll leave you with. Adam Jonas put down a $200 refundable deposit on a new humanoid robot called Neo. It's designed to automate chores. It's scheduled for delivery late this year with a total price tag of $20,000. But here's the detail. The robot isn't fully autonomous yet. When it's sweeping or dusting or unloading the dishwasher, there's a chance a 1X employee at the company's headquarters will be remotely controlling the robot through a VR headset. That's Jonas living his forecast. That's a strategist not just predicting the future, but participating in it. His wife is concerned about privacy in their Westchester County home. His family thinks he's bringing a controversial topic to the dinner table. But that's what happens when you allocate capital to conviction. That's what happens when you believe the future belongs to robots and you're willing to participate in that future personally. Jonas isn't just writing research reports about the robotics wave, he's laying traps at the bottom of the sea. He's positioned himself in the ecosystem. He's anticipated where capital will flow. He's built the institutional framework to capture that flow. And he's waiting to see if the lobster trap fills with something nobody else noticed. Moving to next title. Our gadgets finally speak human. People are talking to their gadgets. Not just a little, constantly. And this isn't the old voice assistant we've all come to resent. This is different. Billions of devices are equipped with microphones and internet connections. More of them are getting generative artificial intelligence. They're getting radically better at hearing and understanding us. And at some point in the not-too-distant future, talking to your phone or your computer is going to be as natural and as effective as typing or swiping ever was. This is a capital allocation moment. This is Silicon Valley realigning where it's betting. This is a new interface paradigm displacing an old one. Here's what's happening right now. A revamped Siri powered by Google is coming to the iPhone. Hundreds of millions of Alexa-capable devices from Amazon already support generative AI Alexa Plus. Google is rolling out an AI model to its smart speakers and Gemini app that understands spoken audio without transcribing it first. ChatGPT, Claude, and Gemini are approaching human-level conversational frictionlessness. Then there's OpenAI's forthcoming hardware, designed by Jony Ive, Steve Jobs' former design collaborator. The unveiling is expected late this year. You couldn't swing a dead cat at CES without hitting an AI-powered gadget that promises to listen to your every utterance. This is shaping up to be the year that AI makes talking as powerful as typing and swiping. The shift could be as transformative for the tech industry as the introduction of the iPhone, Windows, or the Mac. Now let me think about what this means from a capital allocation perspective. Why are tech giants betting so heavily on voice? The answer is friction. Every interaction you have with a device requires friction. You have to unlock it. You have to find the app. You have to navigate to the right screen. You have to tap the right button. All of that friction creates barriers to adoption and limits the types of tasks people will ask their devices to do. But voice eliminates friction. You just talk. You don't have to look at a screen. You don't have to tap anything. You can be doing something else. You can be driving. You can be cooking. You can be walking. And you can still interact with your device. That's why OpenAI has seen a big uptick in adoption of dictation and conversation mode in the ChatGPT app in the past year. That's why Google saw total usage of Gemini quintuple since they added natural language voice interactions. That's why companies are betting hundreds of millions of dollars on making voice the next interface. The technology itself is the enabler. Leland Retches heads voice experiments at Google's Gemini division. He says that Google's native audio model innately understands speech and generates responses without any transcription. People are now having long conversations with the bot, instead of just asking quick questions. This is a behavioral change. This is people allocating their interaction time differently, because the interface finally became good enough to merit that reallocation. Let me map out the capital allocation chain. Google is betting on voice in Gemini and its smart speakers. Apple is integrating voice into Siri and presumably working on expanded AirPod capabilities. Amazon is upgrading Alexa to generative AI. Meta has had surprising success with smart glasses that have microphones and ear speakers. OpenAI is designing dedicated hardware with one of the greatest design minds ever. Why are all of them betting on this at the same time? Because they're all looking at the same horizon. They all see that voice is the interface that works when screens can't. They all see that voice is more natural than typing for most people. They all see that the technology has finally caught up to the promise. But there are two deeper strategic reasons. First, voice is still a monopolizable interface in ways that typing isn't. Apple owns the iPhone. Google owns Android. Amazon owns Alexa devices. Meta owns smart glasses. When you build a voice interface tightly coupled to hardware and an operating system, you create lock-in. You make it hard for users to switch. You capture data about how people talk and what they ask for. That's valuable. Second, voice is the interface that works in the always-on, voice-pilled future. Reid Hoffman, co-founder of LinkedIn, recently wrote about it. For many everyday purposes, voice is simply faster, more natural, and more flexible than typing. And what's changed now is that state-of-the-art AI models can genuinely process what we say. Once that threshold is crossed, once it becomes more convenient to dictate a message than to type it, the economics of interaction completely change. You start using your AI assistant for everything. Not just asking questions, not just giving commands, but real conversations, real dialogue. Leland Retches notes that since Google added natural language voice interactions to Gemini, people have been having long conversations with the bot. Not quick queries, long conversations. Dialogue. That's the behavioral shift the tech giants are betting on. Now let's think about specific capital allocation decisions. OpenAI hiring Jony Ive to design hardware is a statement. I've designed the iPhone, I've designed the iPad. Ive understands how to make technology disappear and let the interaction become the focus. If OpenAI is bringing him in to design voice hardware, that suggests they're betting heavily on voice as the core interface for their future. Google's native audio model is a technical bet. They're saying, we're going to invest in AI models that understand audio directly without transcription. That's an engineering priority. That's a resource allocation decision. Amazon's upgrade to generative AI Alexa is a defensive move. Alexa has been stagnant. Competitors have been eating into Amazon's smart home dominance. Amazon is saying, we need to modernize this or lose relevance. That's capital being reallocated from other projects to voice AI. The hardware bets are particularly telling. Mina Fahmy is CEO of Sandbar, a company testing a ring with a built-in microphone. You lift your hand to your mouth and speak softly to your AI assistant. That's a form factor innovation. That's solving the friction of speaking to a device in public where people feel self-conscious. These are all capital allocation decisions that point in the same direction. Silicon Valley is moving money from typing interfaces to voice interfaces. That's a massive reallocation. Now let me extract the lessons, because there's something important here about interface shifts and capital deployment. First lesson: friction is a moat, but friction can be broken. For decades, Apple maintained dominance through the friction of typing and tapping. The interface was hard enough that switching was costly, but when a better interface emerges, when voice becomes good enough, that moat evaporates. Suddenly, all the capital that was being allocated to optimizing the old interface needs to flow to the new interface. Second lesson: behavioral change precedes technology adoption. Christopher Mims notes that people are already talking to devices constantly. Some are using ChatGPT in their cars. Some are using it to practice languages. Some are having Socratic dialogues about Byzantine history. The behavior is already happening. The technology is just making it better and more mainstream. Third lesson: there's a real risk of cognitive offloading. Mims acknowledges this. We might become less capable of doing the stuff AI can handle. Why learn anything when the answer is one mumbled request away? That's a real concern. But there's also an argument that AI might help us push against the always-on connectivity that has made work-life balance a farce. Here's what I think is actually happening in Silicon Valley right now. Tech giants looked at where people are spending their interaction time: text, email, social media, and realized that all of it could be voice-first instead. They realized that the constraint isn't the interface. The constraint is human attention and time. Voice doesn't create more time, but voice makes time use more flexible and more natural. So they're betting that by making voice frictionless, they can capture more of that attention. By making voice the default interface, they can make themselves more useful and more sticky. That's a capital allocation bet. That's a bet that the future has voice at the center instead of typing at the center. The capital reallocation is already happening. Google is funding voice AI heavily. Apple is integrating voice throughout its ecosystem. Amazon is modernizing Alexa. Meta is building smart glasses. OpenAI is designing dedicated hardware. What's the downside? One is that these companies might be betting on the wrong interface. Maybe people never fully accept talking to devices in public. Maybe privacy concerns around always-on microphones never get resolved. Maybe the technology plateaus and never gets good enough to fully replace typing. Another is the cognitive risk. If we offload too much to AI, if we stop learning and remembering and thinking for ourselves, we might lose capabilities we need. But if this bet works, if voice becomes the natural interface, if people allocate their time and attention through voice instead of typing, then the companies that own the hardware and the software and the underlying models will have captured enormous value. Here's what I'll leave you with. 1 year ago, top executives at major tech companies were debating whether voice interfaces mattered. They were optimizing typing and tapping. They were investing in keyboard shortcuts and touch gestures. Today, they're all betting that voice is the future. They're all allocating capital into voice AI. They're all building hardware optimized for voice. They're all racing to make voice as natural as breathing. That's what a capital allocation shift looks like. Simultaneous, coordinated, and massive. The question isn't whether voice will matter. The capital deployment has already answered that. The question is, who will own voice and extract value from it in a world where talking to your computer is as normal as talking to another person? Jumping to next title, UFC's Empire of Testosterone gets big test. Dana White has a simple answer when asked what connects mixed martial arts to President Trump's MAGA base. He says, testosterone. White has built an empire off it. This is a statement about capital allocation. This is a statement about understanding human nature and monetizing passion. This is a statement about recognizing that the best businesses aren't selling a product. They're selling an identity. They're selling permission. They're selling belief in something that respectable society tells you to dismiss. Over more than 2 decades, Dana White has taken the UFC from obscurity to an operation estimated to be worth more than $20 billion. The parent company is TKO Group Holdings. Last year, entertainment company Paramount agreed to pay $1.1 billion annually for the rights to UFC fights. This is the first year of a global rights deal worth $7.7 billion over 7 years. That's a massive inflection point. That's a pivot from pay-per-view economics to streaming economics. That's a bet that the audience for combat sports is large enough and engaged enough to justify that kind of capital allocation from Paramount. Let me start with Dana White's origin story, because it reveals something fundamental about how outsider operators build empires. White was born in Manchester, Connecticut. He was raised by his mother, who was 19 when she had him. He became obsessed with fighting. He spent Saturdays watching boxing on ABC's Wide World of Sports with his uncles. He tried boxing, but ended up moving into training and then managing fighters. That's pattern recognition. That's someone identifying a passion and a gap. That's someone understanding that he could build a business around what he loved. The inflection point came when White persuaded a pair of high school friends to buy the then-struggling UFC for $2 million. White ran the business. He didn't have credibility as a fighter. He didn't have a network of famous athletes. He had conviction. He had understanding of the customer. He had belief that the sport was the problem, not the audience. A reality show called The Ultimate Fighter changed everything. That show introduced the UFC to mainstream television. It showed people who had never seen combat sports before what the sport was actually about. It wasn't brutality. It was skill. It was strategy. It was drama. Then came the rights deals. Fox. Pay-per-view. These deals lifted the UFC into a new stratosphere. They moved the business from niche to mainstream. But here's where the capital allocation insight gets interesting. White doesn't just run the UFC. He's built an empire of properties within and around the sport. His separate venture, Thrill Sports, puts on Power Slap, in which 2 contestants face off in a face slap match. It became popular on YouTube. Last year, it generated $40 million in EBITDA. That's a business that generates tens of millions of dollars a year based on people slapping each other in the face. That's capital allocation understanding that the demand for combat and spectacle is nearly infinite if you understand how to package it. White is focusing attention on reinvigorating the sport of boxing. He thinks boxing is broken and fragmented. His Zuffa Boxing is a partnership between TKO and Saudi Arabia's Sella Entertainment Company. The plan is to sign top boxers as their contracts expire with other promoters. That's a roll-up strategy. That's understanding that boxing's fractured state creates an opportunity for someone with capital and conviction to consolidate the space. White also joined the board of Facebook parent Meta last year. That's a seat at a table that controls one of the most powerful platforms for content distribution and advertising. That's capital allocation. That's understanding that the UFC's future success depends not just on producing fights, but on owning the pipeline that delivers those fights to the audience. The UFC runs its empire from a 15-acre campus in Las Vegas that includes training facilities for fighters and an arena that can host both UFC and non-UFC events. UFC-related content is produced on the campus. White is considering building a hotel on the site for fighters. This isn't just a sports league. This is a vertically integrated entertainment production company with real estate, content production, athlete management, and distribution networks. Now let's think about the capital allocation decision represented by the Paramount deal. What was expected? The UFC was dependent on pay-per-view economics. Fans had to pay a premium to watch the fights. That kept the ceiling on how many people would watch and how much engagement the sport could capture. The business model was to charge high per-fight prices to a core fan base. What actually happened? Paramount said, "We'll pay you $1.1 billion a year, which is about $90 billion per fight on average, if you assume 50 major fights a year. In return, we get the exclusive right to broadcast the fights on Paramount Plus, our streaming service. The fights become free or bundled with a Paramount Plus subscription. The economics are completely inverted. Instead of maximizing per-fight revenue from die-hard fans, the UFC is maximizing total audience. Instead of 1.5 million buys at $80 per fight, you're trying to get 100 million views at $0, with Paramount paying for the whole thing. That's a capital allocation bet. That's saying the future value of the UFC isn't in selling premium fights to the core fan base. The future value is in being the default entertainment on a major streaming platform. The future value is in the cultural dominance that comes from reaching 100 million people instead of 1.5 million. But there's a risk. The UFC loses direct control over pricing. It becomes dependent on Paramount's strategic priorities. It becomes one property in Paramount's portfolio instead of an independent brand. And if the model fails, if the audience drops when you remove the paywall, the UFC becomes less valuable, not more. White is betting that the net gain in audience size exceeds the loss of direct revenue control. He's betting that being the biggest thing on Paramount's platform is more valuable than being the premium thing in the pay-per-view market. Now let's think about the leverage that White has built. White counts Trump as a close friend. Trump has long been a UFC fan. Trump is hosting a fight on the South Lawn of the White House in June. This isn't politics. This isn't endorsement. This is something more valuable. This is access. This is cultural positioning. This is being the person who understands both the sport and the political movement that's reshaped American culture. White says he doesn't talk politics with Trump. He says the only time he talks business with Trump is fights. But that's probably understated. The relationship is valuable precisely because it doesn't need to be transactional or explicit. White's brand is now intimately tied to Trump's brand. White's audience includes a massive overlap with Trump's base. White has cultural credibility with a demographic that controls a tremendous amount of capital and political power. That's capital allocation in a different form. That's positioning yourself where the power is flowing. White credits Trump with putting the UFC on the map in 2001 by hosting events at the Taj Mahal Hotel and Casino in Atlantic City, a few years after Senator John McCain had called the sport human cockfighting. Trump gave the UFC a venue when no one else would. That's how long this relationship has existed. That's how deep it goes. Now let me extract the lessons, because there's something fundamental here about how outsider operators build massive value. First lesson. The best business models are built around what respectability rejects. The UFC was fighting against the perception that it was brutal and barbaric. McCain called it human cockfighting. Respectable society didn't want it. but there was an enormous audience for it. The audience wanted permission to love something that respectable society told them not to love. White's insight was, don't fight this perception. Lean into it. Celebrate it. Make testosterone and aggression the core of the brand. Once you do that, once you give people permission to be themselves, they're infinitely loyal. Second lesson, build the platform you depend on. White didn't wait for TV networks to decide how to present the UFC. He created reality TV. He didn't wait for promoters to consolidate boxing. He's creating his own boxing entity. He didn't wait for platforms to distribute UFC content. He joined Meta's board. He's constantly building leverage over the distribution channels that matter to his business. Third lesson, positioning is everything when the business becomes cultural. The UFC isn't big because it's the best fighting sport. It's big because Dana White understood that the sport needed a guardian who understood the audience's identity. White is the face of the UFC because he looks and talks and believes like the audience does. That identification is the moat. That's what makes the business defensible against competitors. Here's what I think is happening in Dana White's empire building right now. He's recognized that combat sports and entertainment are converging with politics and cultural identity. The UFC isn't just a sports league, it's a cultural institution. It's a place where a certain type of American, one that respectable society dismisses as unsophisticated, can gather and celebrate values that the mainstream media tells them are wrong. That's extraordinary capital allocation power. That's being willing to build something that respectable society rejects and proving that respectable society was wrong. The Paramount deal is a test. If it works, if the audience stays engaged when the paywall drops, if Paramount's bet on the UFC as a tentpole property pays off, then White has successfully repositioned the UFC from premium to mass. If it fails, if the audience fragments, if the casual viewers who want free content don't develop the same intensity of engagement as the premium pay-per-view fans, then the model breaks. But White has positioned himself such that he wins either way. If the Paramount deal works, the UFC is worth more. If it doesn't work, White has proven that the problem was distribution, not the product. In either case, White's brand, his understanding of the audience, his cultural positioning, his relationships, remains intact. Here's what I'll leave you with. Dana White built a $20 billion enterprise not by being the smartest person in the room or the most technically proficient. He built it by understanding something fundamental about human nature. People want to gather around things that make them feel alive. They want permission to celebrate things that respectable society tells them to hide. They want leaders who look and sound and believe like they do. The UFC is just the vehicle. The real business is providing that permission. The real business is being the guardian of an identity that no one else will celebrate. White is testing whether that identity is big enough and valuable enough to justify Paramount's $1.1 billion bet. If he's right, if the UFC on Paramount becomes the default entertainment on the platform, then White has done something truly remarkable. He's turned testosterone into a streaming business. Moving to next title, artificial intelligence deals fueled venture capital growth last year. Venture capital investment in the U.S. surged more than 63% last year from 2024 to its highest level since 2001. That's a massive inflow of capital into private companies. That's the most venture money deployed in the United States since the peak of the last cycle. But here's what matters. Almost all of it went to one place, the Bay Area. Specifically, $177 billion out of the $320-odd billion in total venture capital deployed in 22,000 went to the Bay Area. That's 55%, more than half of all venture capital in the entire United States concentrated in one region. This is a capital allocation story. This is a story about network effects. This is a story about what happens when winners keep winning and losers keep losing. This is a story about why the game is becoming unwinnable for everyone else. Let me set the stage. Venture capital is supposed to be the engine of geographic diversification. The whole theory of VC is that you back brilliant people anywhere they are. You don't care about geography. You care about the founder. You care about the idea. You care about the team. But that's not what's happening anymore. All the tech minds and the tech talent for AI are converging to the Bay Area. That's the quote from Elliot Labaresh, chief executive and founder of Miami-based Vitalis Ventures. He explicitly says he doesn't think that's changing in the near term. He's conceding the game. He's acknowledging that the centralization is real and that it's going to stay that way. Among the largest venture capital deals tracked by PitchBook in the fourth quarter of 2025, the top 8 were in AI. 5 of those 8 companies are based in the Bay Area. That's more than 60%. That's not a statistical anomaly. That's a pattern. The concentration of capital to the Bay Area has been accelerating for a decade. Kyle Stanford, director of U.S. venture capital research at PitchBook, says it simply. At a time when other markets struggle to build a sustained supply of local capital, the Bay Area keeps adding to its lead. With AI, the feedback loop in San Francisco has been catalyzed into overdrive. That word, overdrive, is key. This isn't incremental change. This is exponential acceleration. This is a feedback loop that's self-reinforcing. Here's the capital allocation history. In 2015, the Bay Area had a certain share of total VC investment. Let's call it the baseline. Over the past decade, 10 years, the Bay Area's venture capital market share grew by 17.25 percentage points. That's a 46% increase in market share. That's massive. Meanwhile, the other 9 markets that ranked in the top 10 for venture investment in 2015 lost 1.28 percentage points in market share on average. That includes Boston. That includes New York. That includes Los Angeles. That includes Seattle. San Diego saw its share of VC dollars drop by a full percentage point. For a small market like San Diego, that's catastrophic. That single percentage point cut its relative size nearly in half. Think about what that means. These are cities with strong networks, strong universities, strong talent bases. Boston has Harvard and MIT. New York has Columbia and tremendous financial infrastructure. Los Angeles has entertainment industry talent. Seattle has a history of successful tech companies. And they're all losing market share to the Bay Area. Why? Because the Bay Area has achieved something that looks like monopoly power in venture capital allocation. It has the densest concentration of successful founders. It has the densest concentration of experienced venture capitalists. It has the densest concentration of successful exits. It has the narrative. It has the network. When you're a founder anywhere else in the United States, you're choosing between 2 paths. Stay local and take whatever capital is available locally, or move to San Francisco and get access to top-tier venture capital. For ambitious founders, it's not a choice. It's a capitulation. Mark Edwards, Chief Investment Officer at Alumni Ventures, describes it as California reclaiming activity. He says the significant amount of industry capital being directed towards AI startups means California is being reclaimed as a real hub of innovation across multiple features of the AI landscape. But reclaimed suggests it was lost. It wasn't lost. The Bay Area never conceded dominance. What's happening is that the AI wave is so large, so capital intensive, and so concentrated in a few companies that all the capital flows there. You want to understand this? Think of it like a gravity well. When you're investing in AI infrastructure, when you're investing in large language models, when you're investing in the companies that will win the AI arms race, you go where the best talent is. You go where other successful AI companies are. You go where the venture capitalists who understand AI infrastructure are making decisions. You go to the Bay Area. Now let's look at who's winning and who's losing. Here's the data. Austin is one region that's carved out a channel against the prevailing current. Austin has grown the amount of venture capital invested in the area by 360% over the past 10 years. That's extraordinary growth. Austin has increased its market share by nearly half a percentage point. Among the 10 biggest VC markets in 2015, Austin had the 3rd highest growth rate in average capital invested per deal over that decade. Austin has risen from 9th place to 5th place over the past 5 years among cities attracting the most venture investment. That's a success story. Austin is the exception that proves the rule. But here's the catch. Austin still gets less than half the dollars of 4th place Boston. That's a difference of more than $8.5 billion. Austin is winning relative to everyone except Boston. And Boston is losing relative to the Bay Area. So Austin's victory is actually a sign of how broken the rest of the system is. Austin has tripled its venture capital over a decade, and it still can't close the gap. Let me extract the lessons because there's something fundamental here about capital allocation dynamics. First lesson: network effects in capital markets are more powerful than most people realize. The Bay Area didn't become dominant because the weather is better or because the cost of living is lower. It became dominant because it has the most successful exits, the most experienced investors, and the most concentrated founder networks. Those create a gravity well. New founders want to be where other successful founders have been. New investors want to be where other successful investors operate. Once you achieve that critical mass, it becomes self-reinforcing. The best talent moves to the Bay Area because that's where the capital is. The capital moves to the Bay Area because that's where the talent is. The cycle feeds on itself. Second lesson: new technological waves concentrate capital in existing hubs rather than democratizing it. You'd expect artificial intelligence, a technology that can be developed anywhere, to spread capital across the country. Instead, the AI wave has concentrated 70% more market share in the Bay Area than it had in 2015. The technology that was supposed to solve geographic constraints has actually exacerbated them. Herd lesson: being the default is an enormous competitive advantage. Austin grew 360%, and it's still in 5th place, still $8.5 billion behind 4th place. That's because the Bay Area is the default. When a venture capitalist thinks about backing the next big AI company, the Bay Area is the default answer. When a talented founder thinks about where to move, the Bay Area is the default answer. Breaking the default requires not just growth, but growth faster than the incumbent. Austin is growing, but the Bay Area is growing faster because all the capital is flowing there. Here's what I think is actually happening in capital markets right now. The Bay Area has achieved critical mass in venture capital. It's not just a geographic advantage anymore. It's a structural advantage. It's an advantage that compounds over time. Every successful exit in the Bay Area creates a new generation of founders and angel investors who reinvest locally. Every successful venture capital firm in the Bay Area attracts talent from other regions. Every big acquisition or IPO of a Bay Area company reinforces the narrative that the best companies come from the Bay Area. That narrative becomes self-fulfilling. Founders believe it, so they move to the Bay Area. Investors believe it, so they deploy capital to the Bay Area. Other regions lose both capital and talent, making it even harder to compete. The outcome is winner-take-most dynamics in venture capital. Not winner-take-all, because Austin and Boston and New York still get some capital. But the winner, the Bay Area, takes the vast majority. The inflection point is AI. Kyle Stanford said it. With AI, the feedback loop in San Francisco has been catalyzed into overdrive. AI is capital-intensive. AI requires dense technical talent. AI requires investors who understand frontier technology. The Bay Area has all three in massive concentration. Other regions don't. They can't build the density. They can't attract the talent. They can't compete with the narrative. So what's the investment implication? The capital allocation question is, if you're a venture capitalist in Boston or New York or Los Angeles, how do you compete? You can't. You have to pick a different game. You have to focus on companies that don't need to be in the Bay Area. You have to invest in companies that are regional or industry-specific or geography-dependent. Austin is the exception. Austin has carved out a niche by being the default for tech companies that want to be outside the Bay Area. Companies are building in Austin because Austin has become the second-tier hub. It's captured some of the overflow from the Bay Area, but that's fragile. Austin is only winning because it's the best alternative to the Bay Area. If Austin becomes too expensive, if rents get too high, if traffic gets too bad, the next generation of startups will move to the next tier, to city. The advantage isn't sustainable. It's just the status quo. Here's what I'll leave you with. The venture capital market is showing you what happens when network effects reach critical mass and when a new technology wave concentrates rather than disperses. The Bay Area isn't winning because of superior management. It's not winning because of a better culture. It's winning because of compounding network effects and a narrative that's too powerful to overcome. Other cities can grow. Austin is growing at 360%, but they can't grow fast enough to break the gravity well. The default is too strong. The network is too dense. The capital keeps flowing north. This isn't an anomaly. This is what capital allocation looks like when the game becomes unwinnable for everyone except the leader. Now, towards last article, banks maul Trump's credit card rate cap. President Trump reiterated his desire for a credit card interest rate cap this week. On paper, that's a huge problem for banks. On paper, it's a revenue destroyer. On paper, it's a regulatory catastrophe. But if the experience of another industry under threat of price controls from the administration is any guide, investors might want to consider buying bank stocks. This is a capital allocation story. This is a story about how political threats don't always play out as threats. This is a story about how industries negotiate with power. This is a story about incentives. Specifically, it's about why the person making the threat has incentives to accept a deal that looks like victory but isn't actually destructive. Let me set up the contrast. Major card lenders, American Express, Capital One Financial, Citigroup, JP Morgan Chase, Synchrony Financial are all down this year. They're down significantly. That's in sharp contrast to the overall market performance of banks, which is strong. The broader large bank KBW Nasdaq Bank Index is up more than 2% in 2026, outpacing the S&P 500. Goldman Sachs, which has exited the card business, has gained more than 8% so far this year. Let me show you what that looks like. On a performance chart from January 2026 to now, you're seeing the KBW Nasdaq Bank Index basically flat to slightly positive. But Citigroup is down, JP Morgan Chase is down, Capital One Financial is down. That's the divergence. That's credit card lenders getting punished while the rest of banking is doing fine. Why? Because the market is priced in catastrophe. The market is assuming that Trump's credit card rate cap will happen. The market is assuming it will be destructive. The market is assuming that card lenders' economics will be materially harmed. But here's where pharma comes in. And this is where the story gets interesting. Last summer, pharmaceutical stocks were similarly struggling with presidential decrees. Trump was threatening drug makers with price controls and substantial tariffs if they didn't voluntarily lower prices. Through mid-August, the NYSE Arca Pharmaceutical Index was down year-to-date, while the S&P 500 was up almost 10%. Pharma was getting hammered. Then something happened. Starting with Pfizer, drug makers struck a series of deals in which they agreed to offer discounted prices via the Trump Rx website and new drugs at most favored nation prices, along with other pledges like investing in U.S. production. And the tariff threat was lifted. From Wall Street's perspective, the fallout from their limited price concessions was manageable. Averting the threat of very steep tariffs or a more aggressive effort to regulate prices was a substantial benefit. Stock analysts' views on the situation included comments such as tariffs, schmariffs, largely benign, and likely a win for the pharmaceutical industry. By year's end, the ARCA Drug Index outperformed the S&P 500. That's the playbook. That's what happened to pharma. That's what card lenders might be hoping happens to them. Now let me think about the incentive structure. Trump makes a threat. He says, I want a credit card rate cap, 10% maximum. Voluntary would be better than mandatory, but I want it. The threat is real. It's credible. Card lenders believe him because he's serious about price controls and corporate power. The market believes him because investors are rational. Stock prices drop. But here's the twist. Trump also has incentives. He wants to be able to claim victory. He wants to be able to point to something and say, I took action. I fought for the little guy. I forced the banks to lower rates. And he wants his economic policies to work. If a blanket rate cap destroys credit card lending, if banks stop issuing cards, if credit becomes harder to access for middle-class Americans, that's a problem for his economic agenda. That's a policy failure. So what does Trump do? He looks for a way to claim victory without actually destroying the industry. This is what Kevin Hassett, his top economic advisor, suggested. He said banks could voluntarily issue some type of Trump cards for people with insufficient access to credit. A Trump-branded product. A Trump-branded victory. What does that actually mean? It means banks offer some cards with lower interest rates, maybe 10% or closer to it, but those cards might not come with rewards, which means banks can keep more of the swipe fees. It's not economically destructive. It's not a policy failure. It's a reclassification of the same economics into a form that looks like the president won something. And banks get something too. They get predictability. They get certainty. They get to know that the threat of an aggressive rate cap has been averted. They get to operate their core business unchanged. From Wall Street's perspective, that's a win. Now, here's where I need to confront the uncomfortable truth. Things could be different for banks than they were for pharma. Washington has considerable regulatory sway over banks via rulemaking and examinations. The largest banks go through the Federal Reserve for which Trump will nominate a new chair later this year. He's already appointed a new head of bank supervision. Trump also just filed a lawsuit against JP Morgan Chase, accusing the lender of closing his accounts for political reasons. So the regulatory leverage is real. The threat isn't theoretical. If Trump wants to make life difficult for JP Morgan Chase, he can. If he wants to impose capital requirements or change lending rules, he can. But that's also why a negotiated settlement makes sense. Trump needs the banking system to work. He needs lending to be available. He needs economic growth. A destroyed card lending market doesn't help him achieve those goals. So the question becomes, will banks negotiate like Pharma did? Or will they fight and lose? Let me think about what the numbers actually mean. Currently, the average credit card interest rate is around 22%. An annual Federal Reserve report said that the annualized return on assets for large U.S. credit card banks was 3.87% in 2024. That's the profit margin. That's what banks are earning on their credit card assets. A 10% rate cap would cut deeply into that. It would reduce profitability substantially. But it might not eliminate it entirely. Banks earn swipe fees on cards. They earn annual fees on some cards. They have reduced costs from lower fraud and defaults on lower rate cards. It's not zero. It's just compressed. But the point is that banks don't know yet if Trump will actually impose a cap. He didn't meet his January 20th deadline. He said he'd ask Congress instead. Congress has been debating credit card merchant fees and rewards for years with no resolution. Congress overturned a Consumer Financial Protection Bureau measure to cap overdraft fees just last year. So there's uncertainty. There's hope that Congress won't act. There's hope that a negotiated settlement will emerge. And there's the Pharma precedent. Pharma negotiated. Pharma got a deal. Pharma stocks recovered. Let me extract the lessons, because there's something fundamental here about how political risk gets priced and repriced. First lesson. Political threats are almost always more dramatic than their actual implementation. The threat of regulation is designed to create fear. Fear suppresses stock prices. Fear creates opportunity for patient investors who understand the difference between a threat and an actual policy. Second lesson. The threatener has incentives you need to understand. Trump wants growth. Trump wants employment. Trump wants to claim victories. Those incentives constrain how far he'll actually go to destroy industries. Pharma understood that. Banks need to understand that too. Third lesson. Negotiation is often available if you look for it. The Trump card concept isn't brilliant policy. It's not economically innovative. It's a way for both sides to claim victory without actually destroying value. That's the playbook. That's what every threatened industry should be looking for. Here's what I think is actually happening in capital markets right now. Card lenders are priced for catastrophe. They're assuming a 10% cap with no modifications, no carve-outs, no negotiation. That's almost certainly too pessimistic. What's more likely is that Trump gets his Trump cards. Banks issue lower rate products. The media celebrates, stocks recover. Card lending economics are roughly unchanged because the lower rates come without rewards, meaning banks keep the swipe fee. That's not devastating. That's manageable. That's a pricing opportunity for investors willing to be patient and trust the playbook. But there's a risk. Trump could decide that banks are different from pharma. He could decide that his regulatory leverage is sufficient to impose actual discipline. He could decide that destroying card lending economics is worth it for political reasons. That's not the base case, but it's the tail risk. And if that happens, if Trump actually does impose a destructive cap, then card lenders are in real trouble. Card lending becomes unprofitable. Banks stop issuing cards. Credit becomes hard to get. The economic consequences could be severe. But that's a low probability scenario. The base case is pharma playbook. The base case is negotiation. The base case is Trump cards and stock recovery. Here's what I'll leave you with. In markets, threats create opportunities. Political threats create especially large opportunities because they're theatrical and dramatic and easy to misinterpret. Card lenders are being punished for a threat that is likely to be negotiated away, just like pharma was. If you believe the pharma playbook will repeat, then card lenders are cheap. If you think Trump is serious about actually destroying card lending economics, then they're expensive. But if you're rational about political incentives, if you understand that Trump wants growth and not economic destruction, then the thesis is clear. Banks negotiated will be the winners. This is Avi. Like and subscribe. On to the next.